Hello number curious friends, welcome to our channel where we get to know accounting and finance. Today we will follow our Apple business from buying materials through production to finished goods and finally to cost of goods sold. In the second part of the video we will look at inventory from a new angle, not only the rules but also the odd cases from real warehouses. Learn something new and avoid the common pitfalls, so bear with us. But first, accounting stuff. Let's get back to our Apple business where we now progress from simply buying and reselling apples to also producing jam. How does our normal operating cycle look like? We start by buying raw apples on credit. Yes, why buy cash when we can hold the payment until we sell our apples to our customers? We are efficient in managing our working capital. And remember, freight-in costs are part of inventory cost. For this one we will pay directly in cash. So we buy 2000 kilograms of apples at $1.40 each, total 2,800. And it costs us $200 to deliver them to the warehouse. Yes, we are scaling the business, time to grow. Journal entries would be: for apples, debit inventory raw materials 2,800. Credit accounts payable 2,800 as we have not paid the invoice yet. For transportation costs, debit inventory raw materials 200. Credit cash 200. As a result, our total Apple inventory on the balance sheet will be $3,000 or $1.50 per kilogram. We also have some jars in stock, but they sit there for some time already, at 20 cents per jar. Now we move part of our raw materials to production, the jam line. The cost leaves raw materials and enters work in process. A quick word on work in process or WIP. WIP is partially completed product. We value it at cost. This cost includes direct materials, direct labor and a reasonable share of factory overheads. But it excludes selling and admin costs, storage after production and abnormal waste. If the expected selling price minus costs to finish and sell is below your computed cost, write WIP down to net realizable value. And now, before we move on with accounting stuff, if you found our lesson useful, please take a moment to hit the like button and subscribe to our channel. This support is very important to us. Thank you very much. So let's move 1200 kilograms of our apples to the jam line, which at 1.5 per kilo will be 1800 of cost. We record work in process 1800, credit raw materials 1800. Now time to add conversion costs. Direct labor is the wages of the jam team. Factory overhead is the fair share of production costs like power and factory rent. And the journal entries will be: debit work in process 1100, we add salaries of the workers. Credit wages payable 1100. Let's assume here we will pay them later in the end of the month, but the cost is already incurred as they perform their work. Then we also add overheads, let's assume $700. Debit work in process 700, credit factory overhead 700. At this point, WIP carries materials plus labor plus overhead for the batch. Total WIP is 1800 plus 1100 plus 700 equals 3600 for 1200 kilograms of apples, or $3 per kilo. Let's assume that by period end only part of the batch is complete, as it takes time to process all apples. The balance left in WIP stays here as ending WIP. Let's say we have fully processed 1000 kilos at $3. Let's put them in jars, 1000 jars, each at cost of 20 cents. First, we increase our WIP by 200 to account for jars. Debit work in process 200, credit raw materials 200. After we are done with putting jam into the jars, we move the completed product from WIP to finished goods. 1000 jars, now at $3.20 each, total 3200. The entry will be: debit finished goods 3200, credit work in process 3200. Now time to sell the finished jam and record cost of goods sold. We make a sale on credit. We post two entries, one for revenue and trade receivables, the other one to move cost from inventory to COGS. Let's assume we sell all 1000 jars for $5 each. Journal entry for sales will be: debit accounts receivable 5000, credit sales revenue 5000. COGS entry records the cost leaving inventory and becoming an expense. Debit cost of goods sold 3200, full amount of our finished goods, and debit for expenses, remember. Credit finished goods 3200, to remove our jars with jam from inventory. This is how we compute our gross profit, Revenue minus COGS. Here we will have 1,800. Let's now have a look what happens when we have returns and write-downs. We can have two common events. First one, a customer returns resaleable goods, meaning we can resell them and recover costs later. Let's assume we get $500 back. Journal entries would be: debit sales returns and allowances 500. We decrease sales, remove the amount directly from revenue. Credit accounts receivable 500. Here we remove trade receivables. We don't expect payment from the customer any longer. And as we got our jars back, we put them back into inventory and remove from COGS. 100 jars at $3.20 each. Debit finished goods 320. Credit cost of goods sold 320. If we think that we will not be able to resell the returned jars at profit, we need to write down their cost to the net realizable value if it falls below cost. For example, if we can resell at $2 per jar, we write inventory down from 320, decreasing it by 120. Debit inventory write-down expense 120. Credit finished goods 120. The write-down brings inventory down to NRV and hits profits immediately. Remember, under IFRS, if NRV recovers later, you may reverse the write-down up to original cost. Then, at month end, we do a physical inventory count and reveal shrinkage in raw materials. 100 kilograms of apples are lost, just disappeared. We need to decrease inventory and book the following journal entries. Debit inventory shrinkage expense 150, each kilogram at $1.50. Credit raw materials 150. And what happens if we have abnormal spoilage during production? For example, a batch is spoiled beyond normal expectations at cost of 150. Then we directly charge that to the P&L as expense, not waiting until sales and COGS. Debit abnormal spoilage expense 150, credit work in process 150. And here is the full path in one picture. Purchase of materials, debit raw materials, credit accounts payable or cash. Materials to WIP with labor and overhead, debit WIP, credit raw materials. Completed cost to finished goods, debit finished goods, credit to WIP. Sales recorded, cost moves from finished goods to COGS, debit COGS, credit finished goods, and the sale itself, debit trade receivables, credit revenue. Returns happen, debit returns, credit receivables, and for the jam jars, debit finished goods, credit COGS. Now we are done with hardcore accounting, and let's have a look at a few special occasions which may happen to inventory. The first one, consignment. Stock can sit in your store, but legal title stays with the supplier. That is consignment. You show zero inventory until you sell the item. Toll manufacturing and third-party logistics. Your goods can live in another company's plant or warehouse. For example, you ask someone to process the apples for you and return jam to you, and you only pay for service. You don't sell apples to your contract manufacturer. The inventory is still yours, even if it sits in someone else's building. Goods in transit. For example, you loaded the goods on truck or ship, and they are on the way to a customer for a few weeks. Who owns the goods on the truck or on board the ship? It depends on contract terms. This is regulated by internationally adopted terms called Incoterms. I'll post the link in the description if you are interested. Check it out. Or leave a comment and I can do a separate video on this topic. LIFO liquidation. Remember that LIFO method, which is last in, first out, is not allowed by IFRS, but it is allowed by US GAAP. What happens here? Normally, the prices go up with time, and if companies use LIFO and sell through old layers where the prices were low, profit can jump in that period, even if nothing special happened operationally. In the description you'll find a link to an interesting article. Check it out. Negative inventory. Systems can show a negative balance when sales postings happen before receipt of goods. In real life, you cannot have negative stock. It is a timing or process issue that needs a quick fix. Vendor rebates and credits. Suppliers often offer rebates after the purchase. This reduces the cost of inventory or cost of goods sold. They are not the income. You need to get the classification right or your margins will look inflated. Moisture and weight loss. Produce, coffee, timber and even metals can change weight with moisture. Some shrinkage is normal and part of costing. Anything beyond normal is abnormal loss and goes straight to expense. Returns loops near year-end. If you expect post-year-end returns that relate to pre-year-end sales, record the expected effect. That affects revenue, cost and net realizable value testing. Unit of measure mix-ups. For example, a team counts 12 cases and enters 12 units, but each case holds 12 further units. The system suddenly shows 1 unit per case and inventory is off by a factor of 12. Always align the unit of measure before the count. Barcode swaps. A cheap item can be scanned at the premium version because 2 labels were switched. Margins collapse on one SKU and look amazing on another, until someone checks the physical tags. The move-in pallet. One team counts a pallet, a forklift relocates it, another team counts it again. The total is wrong. You need to freeze movement during counts or use real-time tracking. That's why a lot of counts are done during night or parts of factories can be stopped to get it done. For example, most counts in retail shops are done during the nights, when the shops are closed to customers and no sales are happening. The pallet of air. Shrink wrap can hide empty boxes or dunnage. It looks like a full pallet from a distance. Counts look perfect until someone opens a carton. Temperature tricks. Liquids change volume with heat. If you switch between volume and mass without temperature correction, your numbers drift. Liquids in transportation systems. For example, when counting oil and reservoirs, you need to account for the oil in pipes between them. Here, knowledge of physics makes it fun. You need to calculate oil weight using diameters and length of pipes and density of liquids to get to proper weight. Same for counting sand, coal, grains and other bulk goods. Mathematics and physics become very important. Okay, now we are done with the full cycle of inventory accounting and let's put a few summary notes. You should capitalize product-related costs into inventory. Move cost from WIP to finished goods when complete. Move cost from finished goods to COGS when sold. Count regularly and reconcile differences to shrinkage or process errors. For transportation, dropship and cross-dock flows, confirm who controls the goods at each point before you book inventory. And now, here are a few further sources of information for inventory. Links are also in description. Thank you for watching. If you enjoyed this lesson, hit like, subscribe and ring the bell so that you don't miss the next lesson. See you soon and keep those debits equal to your credits.